There's a new academic paper shaking up the conventional wisdom on Wall Street. It says workers would have more money in retirement if they invested in an all-stock portfolio. Of course, that runs counter to the advice of many financial advisors, generations of advisors really, who recommend a 60-40 portfolio of stocks and bonds or the use of age-based retirement funds. So joining us now is Bloomberg's Denitsa Tsekova. Denitsa, talk a little bit more about this study and what they found.
Yeah, it's a really fascinating study, and it kind of breaks down all the pillars of investing pretty much. So if you think about putting all your stocks, half of them in international stock, the other half in US stocks, you end up with approximately 1 million by the age of retirement, according to this study. If you split it in the traditional way of, say, a 60-40 portfolio, you're going to end up with 760,000. So that's $250,000 less if you go for the traditional way of investing between stocks and bonds. Obviously, this is a very extreme take of just saying you have to go all in stocks, and it's like,
well, but is it that extreme? I mean, you look at this here. I mean, we're talking about, this is, I guess, based on the study alone, the differential in returns. I mean, those are sizable gains. I mean, you're talking about a 20% differential between the balanced fund and that, and a little bit less, I guess, if you do target dates. But what I also thought was interesting was they showed the drawdowns in those periods. And while the drawdown for stocks was higher, it was only marginally higher, something like, what, 3 percentage points versus a target date fund. So if you adjust on a risk-adjusted returns, I would think that return differential is even greater.
Of course, the math makes a lot of sense. Yeah. It's a really big gain. The risk is obviously bigger if you go for in stocks, but as you said, compared to that, it's not that big. But this has been kind of a long debate, and obviously, like, you don't go into bonds just for the sake of getting that crazy return. You go into bonds because you have that safety, you don't have that volatility. So you can imagine for someone who had to retire in 2000 or 2001, you know, it's going to be a very difficult situation to say to that person, oh, it's going to be better off if you're actually, if you're fully in stocks, and then can you just wait out for stocks to recover? Like, that can be a very painful thing. And obviously, like, the way you think about retirement, you have to have some, you know, some peace of mind. Yeah. And also, like, Cliff Asness has a very famous response to the first time there was such study, and his point was, like, obviously 60-40 cannot give you those crazy returns, but going fully into stocks is pretty extreme. If you go somewhere in the middle, if you have a more leveraged version of the 60-40, or you diversify the 40 part, then you have a more balanced approach where you get the better returns and maybe don't go all into stocks.
Well, having said all of that, you look at the 60-40 portfolio performance so far this year, and it's working. I know 2022 was a totally different story, but it is working overall, and bonds, you know, can be a hedge.
Yeah, of course. I think that's a big part why this study is coming today. We had 2 years of negative performance for bonds. People were wondering, can bonds hedge? Can bonds have positive returns? The correlation has been fluctuating so much, obviously with inflation being such a concern. But yeah, what we're seeing the last month is a very strong performance by the 60-40. And for example, there are other strategies like risk polarity and other quant versions that are a little bit more volatile. They're performing worse than 60-40. So, you know, I think investors tend to chase performance. So you can miss a big gain if you go all in now, maybe.